Hi, my name is Hussein Adatia, and I'm a portfolio manager on the multi-asset team at Westwood, and I wanted to provide a brief update on the markets following an eventful start to the 2025 year. Looking at market returns, we saw a reversal of some of the gains from January 2025. On the equity side, the S&P declined 1.3% and the Nasdaq declined 2.7%. What caused this decline? We believe there are several factors. First, a new Chinese AI startup, DeepSeek, achieved many of the outcomes of some of the larger US peers, including ChatGPT, at a fraction of the cost. This has led investors to re-examine the return on their AI investments and ultimately cause a sell-off in AI-related names as future spending has now been called into question. Additionally, with the new administration taking the helm in late January, we've begun to see their new policies and regulations start to take place. The threat and implementation of tariffs, along with a new stance in dealing with geopolitical hotspots, has led to a market increase in uncertainty and ultimately a risk-off attitude from investors. This uncertainty has led to a flight to quality as Treasury yields declined 20 to 30 basis points during the month. Furthermore, with the rate tailwind, fixed income securities performed very well despite slightly higher corporate credit spreads in both investment grade and high yield. Within equities, communication services and information technology had negative performance as AI spending concerns has led to a broad reevaluation of spending and profitability targets. In addition, consumer discretionary also had negative performance during the month as concerns about the US economy and consumer have increased. Over the past 2 years, the US consumer has struggled with inflation, and we've seen more stress show up in recent data. Mortgage delinquencies, credit card delinquencies, and auto delinquencies have all recently ticked up, and against this backdrop, it's no surprise that consumer discretionary has underperformed. On the flip side, rate-sensitive and defensive sectors outperformed, with consumer staples, real estate, and utilities leading the way. These sectors benefit from stable cash flows as well as increased valuations as interest rates decline. Next, taking a deeper look at fixed income, strong performance was broad-based, with higher quality AAA and AA securities leading the way, which is to be expected given the move in rates. On the corporate credit side, credit spreads widened modestly, but we still remain well below historical levels in both investment grade and high yield credit. Next, turning to our capital markets outlook. Under our operative scenario on the left, we continue to believe that the US economy will avoid a recession, and we have penciled in 2.3% real growth for 2025. However, given the uptick in uncertainty and the slowing economy, we expect there to be 3 rate cuts for the year, and we expect these cuts to be mostly back half weighted. Where could we be wrong? On the upside, if inflation falls faster than expected, if the economy outperforms, and if we have less geopolitical tension, we expect that equities will use this to spring higher as market confidence will improve. On the downside, stickier inflation, stagflation, more tariff wars, or more geopolitical uncertainty would all lead to a broader sell-off in risk assets. Next, turning to our asset class outlooks. We are now neutral on equities as heightened uncertainty leads us to apply a lower equity multiple to S&P earnings. We believe that rate cuts should ultimately provide support for the equity markets, and this will benefit small and mid-cap companies. In credit, we are now slightly negative on the asset class. On the positive side, we have higher starting yields in both investment grade and high yield at 5.5% and 7.5% respectively. However, credit spreads remain near all-time tights, and we do not believe that credit spreads can go much tighter from here. As a result, if we have a slowdown in the US economy, we would expect credit spreads to go wider, which leaves us neutral to slightly negative on the asset class. With regards to rates, given we expect 3 rate cuts for the year, we think the front end of the curve should outperform. Furthermore, we expect the 10-year to remain range-bound, as higher deficits and a slowing economy will likely keep it trading in a broad range between 4 and 4.5%. And finally, our chart of the month. The new administration has been leaning heavily on tariffs to achieve political and foreign policy goals. While this may be a good tool in the long run, in the short run, this creates more uncertainty, which generally causes risk assets to go lower and volatility to increase higher, as is shown here with the VIX chart. We've seen this time and time again, both in the first Trump administration and also since the most recent election. Volatility tends to increase as tariffs are both threatened and implemented, and we expect this environment to continue so long as the new administration uses this to achieve their goals. Thank you very much for listening to the Westwood February 2025 update. If you have any questions, please reach out to your advisor or anyone on the multi-asset team, and we would be happy to assist you with any questions or concerns that you have. Thank you.